I might say that.
All right, live.
I don't see the recording, but why?
Mhm. Can you put the banner up?
I don't find the recording.
Hmm.
Do you see it?
Yep, got it. One more coming in. All right. Good afternoon, everyone, and thank you all for joining us for today's A Month of Service presentation of foreclosures, mortgages, HELOCs, and reverse mortgages or home equity lines of credit. My name is Nia Murray. I am the programs coordinator with Neighborhood Recovery Community Development Corporation, and we are one of the partners in the A Month of Service collaboration. Also included, we have the City of Houston's Department of Neighborhoods. And on behalf of our presenting partner with Lone Star Legal Aid, today we have Miss Lisa Everett and Miss Samantha Guzman, who's going to be giving you all the information today about foreclosures. Also included in the collaboration, we have the Earl Carl Institute, Texas Legal Services Center, Houston Volunteer Lawyers, Harris Central Appraisal District, and the Harris County Tax Assessor Collector's Office. And together we make up a month of service. And basically, a month of service is the collaboration of all 8 of our organizations coming together on a monthly basis and offering a variety of different workshops, resources, and information to the community relative to asset building, asset protection, maintaining of generational wealth, and community empowerment. We decided several years ago to collaborate together and try to create a larger impact and get as much information out to the community. So we collaborated and pooled a lot of our initiatives together and kind of expanded on a lot of the things that we each were already kind of doing and basically wanted to create a larger impact. So we feel that the people were pretty much better served by us collaborating and trying to get as much information again out to the community as we can in an effort to reach more people. And this platform has allowed us that opportunity to do just that. In addition to just reaching the people around the city of Houston, we also reach people throughout the entire county, surrounding counties, as well as across the state with the information relative to those topics that are most important to people in the community. We know that asset preservation and asset protection is one of the leading things that impacts generational wealth. And we again wanted to make sure that we all did our part to provide the most accurate and up-to-date information to the communities that we all serve. So today's presentation is part of a 3-part kind of foreclosure series that we have decided to come up with. We have broken up the foreclosure topics into 3 segments, one being the mortgages and home equity lines of credit, reverse mortgages, and kind of like the for sale by owner, and they're going to go over what that actually means, as well as the property tax foreclosure and the HOA foreclosure. So we do those on a rotating basis, and this month we are on mortgage foreclosure. So if you would like to hear about the other foreclosure series, then you can come back each month or visit our YouTube channel where you can see those previous presentations, or just reach out to me or one of our partners, and we can make sure that you get the link to those so that you can go back and watch those as well. So with that being said, there's a lot of information that's going to be covered here today. We hope that you all get the information that you intended to receive. This is your opportunity to ask questions of the legal professionals that are experts in the area of foreclosure. However, we do want to try to protect your privacy as best as we possibly can. So we ask that you try to keep your questions general, not to get too specific and divulge any personal or detailed information about your personal situation, as I'm sorry, excuse me, as that we are on a public platform, as well as trying to keep dog at bay so she doesn't bark too much here. Trying to make sure that we protect your privacy as best as we can. So we don't want to divulge any of that information out there for everybody to have access to. In addition to that, we do record the session as well as broadcast on our social media platforms. So if you are joining us today on Zoom, feel free to type your questions into the comment section. If you are, I'm sorry, into the chat box. If you are watching on our social media channels, feel free to type your questions in the comment, and we'll make sure that those get addressed for you at the end. Um, let's see if am I forgetting anything. Oh, the information that does get provided is for educational purposes only. It is not considered legal advice. However, we do encourage any of participants, if you are interested or in need of any civil legal assistance, that you do reach out to our legal service partners and apply for their services. So we do definitely encourage you guys to do that. Don't automatically assume you don't qualify for it. You just never know, and the services are there and it's available for you to help. So without further ado, we're going to get into our introductions and we're going to move right on into the presentation. So again, we want to thank everybody for joining us this afternoon, and let's go ahead and get started. So Samantha and Lisa.
Hi, everybody. I am Samantha Guzman. I am a paralegal here at Lone Star Legal Aid in our foreclosure prevention project. And I'll be doing our intro slides today. So, Miss Lisa.
I'm Lisa Everett, a staff attorney in our Housing and Consumer Department, and I will be giving the presentation, the substantive presentation. And just like Nia said, this is only legal information and not legal advice.
Okay, so let's jump right into it. Let me share my screen. Okay, so today's topic, we are going to be talking about mortgage foreclosures. Again, today's presentation provides legal information only. It's not legal advice. We cannot tell you what type of mortgage loan or loss mitigation options is best for you. And if you don't know what loss mitigation means, it means trying to rectify your past due mortgages, your mortgage loan. Anyways, you should also contact your financial or tax advisor and lawyer for advice regarding your personal situation. Our agenda today, I'll give some brief information about Lone Star Legal Aid, and then Lisa will cover mortgage foreclosures in general information, loss mitigation, including successors and heir properties, specific mortgages, and then at the end, we will have a Q&A. So if you do have questions, you can put them in the chat, but we will address them at the end of our information. So here at Lone Star Legal Aid, we protect and advance the civil legal rights of the millions of Texans living in poverty. We serve 76 counties by providing free advocacy, legal representation, and community education that ensures equal access to justice. Of course. So Lone Star Legal Aid serves about 60,000 square miles across 72 counties and 4 in Southwest Arkansas. Our staff operates from the Houston office as well as 13 other offices in cities including Beaumont, Galveston, and Waco. There are nearly 2 million people in our service area who qualify for help based on federal poverty guidelines. And in 2024, Lone Star Legal Aid handled over 25,000 cases, assisting 61,000 people, many of whom were survivors of domestic violence, who are seniors or veterans. Oh, very sensitive that thing is. So let's talk about the people we serve at Lone Star Legal Aid. Here we help some of the most vulnerable members of our community, including children, veterans, seniors, people with disabilities, members of the LGBTQIA+ community, and individuals who are experiencing homelessness. The majority of our clients are women, and many of them are mothers trying to care for their families. And a lot of the people we serve live in rural, it's a very hard word for me, rural or remote areas, and they may face isolation because of limited literacy or language barriers. And many don't have reliable access to internet, or they don't even have phones. In fact, more than 1.5 million people in our service area speak a language other than English at home. So language access is a big part of our work. The need for legal help is far greater than the number of attorneys available. In fact, in Texas, there's only one attorney for every 380 people in the general population. So that's all of Texas. There's only one attorney for every 380 people. But in our Lone Star Legal Aid service area, there's only one legal aid attorney for every 17,000 eligible low-income residents. So I'm going to let y'all take that in for a minute. In Texas, the whole state of Texas, there is only one attorney for every 380 people, but there is only one legal aid attorney for every 17,000 people in our Lone Star Legal Aid service area who are eligible low-income residents. And finally, many of our clients don't have access to basic communication tools like phones or computers. And also public transportation is rare in most of the rural areas we cover, making it harder for people to get legal assistance. Our mission again at Lone Star Legal Aid is to protect and advance the civil legal rights of the millions of Texans living in poverty by providing free advocacy, legal representation, and community education that ensures equal access to justice. So who is eligible for our assistance? Well, we help people living in the 76 counties that we serve. We only work on civil cases. We do not work on criminal cases. We do not work on personal injury cases, and we only help those who are low income. So some substantive law types that we work on include consumer, employment, family law, healthcare, housing, juvenile issues, neighborhood problems, public education, and financial assistance and public benefits. We also have some special projects that we work with here at Lone Star Legal Aid, and those include our Civil Matters and Criminal Justice Project, Community Advocacy, our Crime Victims Unit, we have a Disaster Relief Unit, an Environmental Justice Project. We also have a Low-Income Taxpayer Unit, as well as our Medical Legal Partnership. We have a Legal Assistance to Survivors of Sexual Assaults Project, Eviction Rights and Counsel, Fair Housing, we have a Military and Veterans Unit, and then we have our Foreclosure Prevention Project. How do you ask for help at Lone Star Legal Aid? Well, you can always apply online at www.lonestarlegal.org. Again, that's www.lonestarlegal.org, 24 hours a day, 7 days a week. And for those of you who do not have access to the internet, you can give us a call at 1-800-733-8394, Monday through Friday during regular business hours. Or you can visit one of our offices. So I know we mentioned that we had 14 branch offices, and I'm going to give you some information about those. So we have offices in Beaumont and Conroe, Belton, Galveston, Bryan, Texas, Houston, Clute, Longview, Nacogdoches, Tyler, Paris, Richmond, Texarkana, and Waco. You can see the little O at the bottom. We need to edit that. Sorry. And so you can also follow us on social media. All of our social media handles are at Lone Star Legal Aid. We are on Instagram, Facebook, and YouTube. Again, this is just a spot for our website. It's www.lonestarlegalaid.org. And now I'm going to stop sharing my screen and let Miss Lisa take over so she can give you some information about mortgages and mortgage foreclosures.
Thanks, Samantha. It took me a second to unmute myself. Sorry. So I'm going to go ahead and get started. So we're going to be covering mortgage foreclosures today. There's several types of mortgages that we're going to be going over. Forward mortgages, known as purchase money mortgages, that's the traditional mortgage that people most likely think of when purchasing a home. Reverse mortgages, also called home equity conversion mortgages. Deferred balance or partial claim lien resulting from modification of a mortgage, that can also be known as a second lien. Home equity loans and home equity line of credits, HELOCs. Those are also second lien, loans on your home. Seller financed under executory contracts or contract for deeds, and zombie second mortgages. So what happens when a person buys a home is the mortgages place a lien on the buyer's home, the borrower's home. When most people are buying a house, if they are financing it, they are borrowing money, or they're borrowing money to pay off the home loan, the note on the loan. A lot of people say that they don't own their house. The mortgage company owns their house. Actually, if you're getting a traditional mortgage, you have title in your house, but the person that's financing the loan has a lien on the home, and they have the right to foreclose on that lien if the debt obligations, the monthly payments, the mortgage payments aren't made. So, and then they would get, then title would transfer after that. But so a lien is an obligation to pay the debt. That's what most people call their mortgage payment. And it can be enforced by selling the home, and that's foreclosing on the home, if the borrower doesn't pay according to the terms of the contract creating the lien. And here we're calling that the mortgage. If it is foreclosed on, the home might sell for less than the market value, which can reduce, when people buy a home, they're building up equity, and that the home is an asset. And so if it's sold for less than what it's, the market value, there's a loss of equity as well. So the main players in a mortgage are the owner, the investor, or the insurer. Those are the same party, generally speaking. That's the entity that owns the loan, or backs the mortgage loan. And that's not the people we interact with. We're going to talk about them on the next slide. So whoever the investor, owner, or insurer is, it dictates what type of loss mitigation options are available to a borrower if the borrower needs them. The different types of owners, investors, or insurers could be federally backed, such as Fannie Mae, Freddie Mac, Ginnie Mae, the Federal Housing Administration, FHA, which is a department of HUD, the Housing and Urban Development Department, the VA, Rural Housing Services, and it can be part of a USDA loan as well. Or the owner, investor, insurer can be a private entity like a trust or a bank. So it's federal or private. The loan servicer is the person that the borrower, the home buyer, interacts with. That's the agent of the owner, the investor, or the insurer. So the loan servicer is the person who sends out the monthly notices, the person who receives the payments, the person, if you're paying an escrow to if they require an escrow for the insurance and homeowners insurance, they're the ones that prepare the escrow documents as well, and balances. And if someone needs to engage in loss mitigation services, they work with the loan servicer, the agent, when you're trying to get out of default. And they can only offer the loss mitigation that the investor allows. And so it is different depending on whether or not it's government or private. So everyone should know that they don't get an option on who the investor is, or the owner, or the insurer. They can get sold multiple times and you probably won't even know it. And the investor gets to pick who the loan servicer is. And again, the buyer doesn't get any choice in that either. When the servicer changes, not the investor, but the servicer, the person that the buyer interacts with, changes, you get a letter telling you to start sending your payments to the new servicer. Sometimes they are the same company, but oftentimes they are different companies. So the general framework for mortgages in Texas, you're looking at Texas Property Code Chapter 51, the Texas Constitution, Article 16, and you're also looking at the loan documents themselves, and normally you're looking at the deed of trust and the promissory note. So In order for a home to be foreclosed on, there has to be a default. So that means normally in a home buying situation, a default is missed mortgage payments. It can also be failures to pay property taxes or failures to get or keep property insurance. And if there is a default, borrowers can often, not always, there might be loss mitigation options available to avoid a foreclosure. Just 1 second. Okay. So the main reasons why people default on mortgages could be, back in the, mortgage crisis, it was because there were a lot of high interest loans and variable interest loans. When the interest rate changes, if the interest rate goes up, it means the mortgage payment goes up. So it could make it unaffordable. Another common reason is what we call the 3 Ds: death, divorce, or disaster. So when a family sees one of those, sometimes there can be, insufficient money to pay mortgage payments or the, property taxes or homeowners insurance. Also, sometimes people can't afford it because they have increased expenses due to like significant medical expenses from illness or injury. And with reverse mortgages, there's often misunderstandings about the homeowner's obligation. So in a reverse mortgage, we'll talk about it more later, the homeowner doesn't have to make monthly payments, but the homeowner still has to pay property taxes, even if they are eligible for a deferral, and they have to maintain insurance and maintain the home as well. And so those are the not paying property taxes or not paying homeowners insurance is a common reason for default for reverse mortgages, especially. So in general, Texas is a non-judicial foreclosure state. That's not true in every situation for foreclosure. We'll talk about that later. That means that you're like with a traditional mortgage, what I'm going to call like the purchase, when you get a loan and you have that one lien on the home, that's what I'm calling the traditional mortgage. I think is what most people think about when they think about a mortgage, not any second liens or things like that. For those types of mortgages, the mortgage lender does not have to go to court to get an order to foreclose. They can just follow the process. And so it's just something to be aware of. The foreclosure sales are always the first Tuesday of the month. There's an exception. If the first Tuesday falls on January 1st or July 4th, then it will be that Wednesday. But other than that, it's always the first Tuesday. Under federal law, a servicer can't send the first foreclosure notice or file a foreclosure lawsuit until the loan is 120 days delinquent. So that means that you pretty much have to be 4 months delinquent before they're allowed to initiate foreclosure processes. The loan servicers are required to send the borrower a notice of default, giving them at least 20 days to fix the default. You could be more than 20 days delinquent, but they have to give you 20 days to get caught up. And if the default's not fixed, then the loan servicer can accelerate the loan, which means that the entire amount is due. So if you don't fix the default in 20 days, you owe the entire amount on the loan. So if you're buying a home and financing $250,000 and you're $50,000 of the way in and don't have homeowners insurance and you don't get that fixed, then they can make the entire $200,000 due all at once. Then they can, once they've accelerated the loan, they can begin the non-judicial foreclosure process, or if it's the type of loan that where they do have to go to court, then they can start the lawsuit. It depends. It just depends on the type of loan and the type of default. If your home is foreclosed on, the next owner has to file an eviction to remove you. So just because the home is foreclosed on doesn't mean you have to move immediately, but the next owner will have the right to file an eviction against someone who's still in the home. So when there's a non-judicial foreclosure, the no lawsuit foreclosures, It occurs when the terms of the mortgage allow the lender to foreclose without a lawsuit. Those are most traditional mortgages. Like I said, if the default isn't cured within 20 days, then they have to send the borrower a notice of foreclosure sale at least 21 days before the scheduled sale. They don't have to prove that you received the letter. They only have to prove that they mailed it. With a reverse mortgage, the non-judicial foreclosure is generally only after the last borrower dies. The lenders are supposed to reach out to heirs from reverse mortgages, but sometimes they don't find them or reach them. So it's really incumbent upon heirs to be proactive. So judicial foreclosures, they occur when the terms require the lender to file a lawsuit to foreclose. Sometimes, even if a lender is not required to file a lawsuit, they still can. Sometimes they'll do it when there's heirs or fractional property interests, but they still don't have to do that. Sometimes the lawsuits are expedited. And when a lawsuit is expedited, it means that it moves really, really fast. So, if you've heard about lawsuits in general, you can hear that they can drag on for a long time. Evictions are expedited suits. They don't take a long time. And expedited foreclosures don't take a long time either. So after a person is served, and they're served by getting mail from the county clerk, they have 38 days to respond. If a person doesn't respond in those 38 days, then the servicer can get a default, meaning that the court will give them the order to proceed with the foreclosure sale. So it's a very quick process. With a reverse mortgage, judicial foreclosures are generally required if the borrower isn't paying the property taxes, HOA fees, or insurance. It'll be non-judicial if it's just the borrower dying or the last borrower dying. After the lawsuit, so if there is a judicial foreclosure, the loan servicer still has to send the 21-day notice before the scheduled sale date. They don't have to prove that you receive it. They just have to prove that they mailed it. So if people are facing foreclosure, so foreclosure lists are public documents. The first Tuesday foreclosure day of the month is all that information is filed with the Harris County. People buy these records, including scammers, and scammers will reach out to people who are being foreclosed on and try to take money from someone who is in that stressful situation and under duress, and try to trick them into giving up money or their home. So because it's recorded at the county clerk, it is a public record, and so people do know who's being foreclosed on. Scammers might contact someone saying that they can stop a foreclosure. One sign it's a scam is that they require fees up front without any services. There should be a giant, blinking warning sign if someone is contacting you to do this kind of thing. Sometimes they get letters from investors as well saying I'll buy your home and pay off, whatever. So it's possible that it's legitimate, but I'm just saying oftentimes it is scamming. Don't feel pressure to do anything. The Federal Trade Commission does have useful information and articles about foreclosure scams. The Federal Trade Commission actually has a lot of useful articles on a lot of different types of scams, not just foreclosure scams. And so it's actually a great resource for kind of figuring out what's out there, because if you know what the scams are, if you encounter it, you're more likely to click on that light bulb that says, oh, this is a scam. I shouldn't respond. I shouldn't give this person money. I shouldn't give this person my information so they can steal money from me. So I'm just saying that FTC is a great resource for that. If someone's contacting you, you can always reach out to a HUD housing counselor. They don't actually work for HUD, but they're not all housing counselors are created equally. You wouldn't do a HUD housing counselor, not a non-HUD housing counselor, or a law firm, including Lone Star Legal Aid. So some of the scams are phony counseling. They'll pretend to be a housing counselor or an attorney, and they want payments to negotiate to stop the foreclosures. They'll say that they're going to negotiate with the lender, bring the loan current, or lower the payments. Sometimes they'll ask for the payments to be made directly to them. Normally, if they're requesting payments, they are just pocketing and never reaching out to anyone. Rent to buy ripoff. Sometimes they ask you to deed the property to them and then they rent it back to you until it's foreclosed. And sometimes the equity skimming scams, they want you to sell your home for them for cash for much, much less than what the home is worth. And this is a way, so when a home is sold at a foreclosure sale, it does not have to be the market price. Most foreclosure sales, like the lender has the option of saying that I don't want it to be sold for less than the amount we are owed on the loan, and our attorney's fees and court costs or, things like that. If it sells for more than that, then those are excess proceeds. And the homeowner can get the excess proceeds. If you're no longer the homeowner, you're not entitled to those excess proceeds. So loss mitigation is a way to try to avoid a foreclosure if you might be facing one because of a default. And when you're looking at loss mitigation, we're looking at federal regulations, the Real Estate Settlement Procedures Act, often called RESPA, Regulation X, and it can be found at 12 Code of Federal Regulations, Section 1024. And we're also looking at Texas Property Code, Chapter 51. So loss mitigation is when you work with your loan servicer to avoid a foreclosure after there's been a default. Home retention is a type of loss mitigation that might offer the plan of paying back the outstanding balance or renegotiating the original terms of the loan, or some combination of solutions. Home retention means that you keep the home instead of giving up the home. All loan servicers should offer some type of loss mitigation. Not all borrowers qualify for loss mitigation. A graceful exit is not home retention. That's where you get out of the loan and without a foreclosure, but you don't keep the home. So home retention means you're staying in the home. Other things, you're just not doing a foreclosure, but you still lose the home. In general, loss mitigation options, they vary based on the type of the loan, the investor, that's a huge, huge factor, and various borrower eligibility factors such as income. If someone has lost their job and they have no way of paying back a loan with a repayment plan may not be an option, even though for that borrower, even though repayment plans might be an option for that investor. So just be aware that it's not, you have to be able to meet the eligibility qualifications. So home retention options could be reinstatement of the loan, a forbearance, meaning that you have a time where you don't have to make payments. It doesn't mean that those payments go away. It doesn't lower your loan balance. Those payments will have to be made, either tacked on and spread out through the rest of your loan, maybe a balloon payment at the end. It's not that they're not made at all. They're just not made for a certain amount of time. A repayment plan where you repay the loan, either at the end of the loan, extend the length of the loan, or make your loan balance higher. A loan modification, that might be an option, especially if interest rates have gone down, or it might say that you're going to make your 15-year loan a 30-year loan. I'm just throwing stuff out. I'm not saying that those are the ones, but just trying to explain what modifications are. Deferred balance or a partial claim, and there's different options for reverse mortgages, and we'll talk about those later. So, like Nia said, one of the things is that homes are a way of building generational wealth. And so sometimes there are issues when heirs are trying to figure out how to keep a home. And so now we're going to talk a little bit about heir property ownership and tangled title. So if someone has a mortgage or a home equity loan or something like that, then, and if someone dies, then it becomes, the heirs, sorry, I don't want to go into like Texas probate law right now, but heirs are who inherit at law. If there's a will, then it's a beneficiary, and you have to probate a will and things like that. But heirs are people that are entitled to own a home or own the person who dies, their assets because of the laws that say I am an heir to this person's property. And the issue is that when someone dies, the mortgage servicer often won't talk to the successors in interest because they will only talk to the person on the mortgage, but that person has died, so no one's available to talk to them. So it can also happen in a divorce. So if someone divorces and one person gets the mortgage, but the other person's name was on it, they might say, "Oh, I'm not talking to you. I'll only talk to your ex-spouse, your ex-husband, your ex-wife." So it's but those are two situations where there's successor and interest. Once a successor and interest is confirmed, they are considered and treated like a borrower. The successor and interest has to prove that the borrower has died or there's been a divorce. So that would be a divorce decree or a death certificate. They also have to prove that they have a title interest or a legal right to the property. That can be done in probate. It can be done with an affidavit of heirship. There's multiple ways of doing it. These documents, the documents that are required to prove successor and interest status, have to be reasonable in light of the laws of the relevant jurisdiction. So the typical issues that successors might encounter are that they can't communicate with the loan servicer. That's because they'll only talk to the person who's named on the account, the person who's died or the person who, divorced. Sometimes they don't receive monthly statements or notice letters, so they don't know what's going on with the loan. They may not be named on the homeowner's insurance. And so like if someone needs to file a claim for the homeowner's insurance, if there's a disaster, they won't talk to them either. They can't access the servicer's website, with the login and if you have to enter your email address, it's not your email address, it's the person who's died email address and things like that. They can't engage in that loss mitigation that they could be eligible for. Sometimes they'll require an ex-spouse to sign off on loss mitigation documents when it shouldn't be required. Sometimes they'll ask for unreasonable documentation to confirm successor status. Most often we see that in the form of requiring a court order when a court order should not be required as reasonable under the jurisdiction's laws. And also sometimes there are instructions to establish that status. Successor and interest status can be confusing. So successors and interests are often called heir property owners. And in this type of situation, I'm talking mostly about when someone has died, not the divorce, because heir refers to someone who's died. So an heir property is created when a prior generation of homeowners don't probate the estate of the record title owners. So at Lone Star, we'll often see someone come in, there's an issue with the home, and they're living in their grandmother's house. But when the grandmother died, there was no probate. And when the grandmother's children died, there was no probate. And so there's no clear chain from grandma to the person who's in our office. So often title ownership will pass under the laws of intestate succession. Intestate means there's no will. So when in a will, you get to decide who your property goes to. If there's no will or a will's not probated timely or things like that, then it falls under the laws of intestacy, which means who takes under the law. So intestate succession means that there's no will. And title passes to numerous people. So if grandma had 5 children and each 5 children had 5 children, then you're talking about 25 heirs potentially, not just one heir. So sometimes a will exists, but it leaves property to multiple people, or they died, or the people that it was left to died intestate. So let's say grandma did have the will and she said, I'm leaving it to 2 of my children. The other 3 moved to Europe. I don't know what. And so, but one of those children dies without a will. There's still issues with intestacy, and intestacy means dying without a will. So, so it can still you have to keep doing it at every level. And that is something that Lone Star can help with. And also some of the other organizations that were pointed out at the beginning of this presentation, the partner organizations. And so when you have situations where you have a bunch of heirs and there's no clear, title, chain of title going from one person to the next or from one person to multiple people, that can be referred to as tangled title. So so when there's multiple heirs, it can also, create issues with establishing successor and interest status. And it will also cause issues if an heir wants to, or the heirs want to sell a home. Get home equity loans, get government assistance to rebuild a home that might be messed up by a disaster, because you're supposed to have everyone sign off to sell a home, and that can create issues too if you don't know where all your family members are, or someone's cousin. It can just be difficult when people when extended families can get very large, and sometimes it's hard to keep up with everyone. It can also result in tax foreclosure when the heirs can't afford the taxes, especially if they remove exemptions that the heirs might otherwise be entitled to. It's really important to know if someone is living in a home, and maybe even that they don't have like clear title to, as long as you are eligible for a tax exemption or a tax deferral, that person, if they live in the inherited property that they have a title interest in, it doesn't mean they have to own 100% of it, but they own some portion of it. They are eligible for the homestead tax exemptions and tax deferrals if they otherwise are qualified, but that does not clear the title. Getting a tax exemption or a tax deferral does not make that person the only owner, and it doesn't clear up all those issues of not probating and not taking other alternatives to probate. So sometimes the mortgage company just makes mistakes. And if there is an issue, you want to escalate it with the loan servicer or the investor. And so there's contact information if you know who owns the loan or if this is your servicer for Fannie Mae, Freddie Mac, and FHA. You can also contact the Attorney General, the Texas Office of Consumer Credit Commission, and the Consumer Financial Protection Bureau. I want to note that the last three, they will not intervene on your behalf. But if, like, Texas officials find out that one servicer is repeatedly messing up, they might reach out to the servicer and say, hey, we hear you have problems, you need to fix it. But they're not going to intervene on your behalf. However, no one knows there's an issue with a servicer or an investor if no one's reporting it. So while it doesn't benefit you directly, it can help on a larger scale if enough people are reporting it so that they know that there is an issue that needs to be investigated or looked into to help get them back on track. Borrowers and successors in interest have the right to send their loan servicers request for information that's called an ROI or notice of error letters. It can also be called a QWR. It must be sent to the correct address, and that address will normally be found on a mortgage statement or the servicer's website. If you don't send it to the right address, they don't have any obligation to reply. You can use these letters to ask the servicer for information like available loss mitigation options or to find out who the investor or owner of your home is. There's also a place where you can go online to look that up if it is yours, if it is your home, if you're the borrower, to find out who the investor or owner of the home is. And I apologize, I don't have that website right now, but if you look up, like, it's a MERS website. Sorry, I'm getting up, but they're also required to tell you who the owner or investor is. And if you know who the owner or investor is, then you know what the options are. You can also use it to notify them that they made a mistake, like failing to recognize someone as a successor in interest, or, like if they didn't attribute your payment correctly, they're just not counting your payment, but you have proof that you made your payment, things like that. They have 30 days to respond, not including weekends and holidays, so that's more like 45 days. And they can also ask for a 15-day extension. So if you want help writing a letter to your loan servicer, Lone Star Legal Aid has a tool to help you write that letter. If you go to lonestarlegal.org, there is an area on the website that's called a resource library. And if you click that, it will prompt you and start going through the tool of what you are trying to do and what you need to do. And it can help you write a letter like that. So when you go to the resource library, there's all these different topics. I don't know if you can see my mouse or not, but like what you're seeking help with, and you would go to foreclosure and it would help write a letter. This foreclosure tool can also help with things like if there's a lawsuit, like for filing an answer or response in a lawsuit. So it's not just writing the letter. So just be aware that there is an option to help you do it yourself. Like Sam said, there's one attorney for every 17,000 people, one legal aid attorney for every 17,000 people. And so we obviously can't help everyone. And so we're trying to extend what we're able to help people with by making these self-help tools. So now we're going to talk about home equity loans and HELOCs. A home equity, first we just need to discuss what home equity. The equity that someone has in their home is the value of the home minus all of the loans on the home. So in this example, if your home is valued at $100,000 and you have a $75,000 mortgage and no other liens, then there is $25,000 of equity in the home. If you owe another $5,000, it says, property tax lien. And just so you know, the minute the property taxes are due and not paid, there is a lien created by operation of law, whether or not there's a lawsuit. So if money is owed, like if $5,000 of property taxes is owed in this example, then there's only $20,000 of home equity. So home equity, you can figure out by just deducting the amount owed on the home minus the value of the home. A home equity loan allows you to borrow money using the equity in your home as collateral. They normally have a fixed interest rate. You normally receive a lump sum up front, like when you take out the home equity loan, and you pay it back like a regular mortgage. So you'll have two mortgage payments a month, the home equity and the mortgage payment, if you have a mortgage. You have to have some equity in your home to be able to get a loan. If you just bought a home, most people, when they just buy a home for the first year, have virtually no equity in their home. The way it works when you're paying a mortgage is like in the beginning, 99% of your first bill is interest and 1% is equity. And then it shifts. And then your last payment is like 1% interest and 99% equity. And so your initial payments, you're not building a lot of equity with your initial payments because the majority of your payment is always going to be interest in the beginning. So just be aware of that. It takes time to build it over time. If you get a home equity, you can get a home equity loan without having a mortgage, in which case you would just have one payment. But if you also have a mortgage, then you have two payments. You can use the money for home repairs or other needs. And like I said, if you already have a mortgage, then that's a second mortgage. If you default on a home equity loan, the mortgage company can foreclose. I think, Texas has a lot of protection for people's homesteads. It is not unlimited protection, though. When you use your home as security or collateral or the basis to receive a loan, if you don't pay that loan back, that lender can foreclose on your home. HELOCs are home equity line of credit. They normally have a time period at the beginning called a draw period or the borrowing period where you can borrow money and you make minimum payments. After the draw period ends, you can't borrow any more money. And then you will also enter a repayment period where you have to make payments on the money you already withdrew. Sometimes this will result in a balloon payment at the end of the loan. So maybe you're making payments of $500 or $1,000 a month. And at the end, you have to pay $20,000. You need to be very aware what the terms are. If you're not paying it all over the time, you need to look at what you're actually paying and what's going to be owed at the end. So some people are allowed to refinance those balloon payments, but you just have to be aware that it comes up. Some people are caught unawares and not realizing the amount they were going to be like having to pay all at once. And they usually have adjustable interest rates, which means that the monthly payment can go up and down depending on the interest rate. And same as before, a home equity line of credit, you are using your home as the collateral for the loan, the equity you have in the loan, in your home. And so if you default on that, they can foreclose. We're going to talk about reverse mortgages now. Sorry, I'm just trying to see what time it is. So a reverse mortgage is a special type of home equity loan that is designed to help people who are homeowners, you have to be the homeowner, age 62 and older, who own a home and live in it as their primary residence. When a person takes out a reverse mortgage, they have no personal liability to repay the loan. The security is the house only. So when someone gets a reverse mortgage, they normally get this one big lump sum payment, and they don't have to They don't have to pay it back, but they are still required to pay property taxes, HOA fees, and homeowners insurance, and they have to be paid on time. So someone that's over 65, under the laws of Texas, can defer their property tax payments. If a person has a reverse mortgage, let's say they're 70, they get the reverse mortgage and they defer their property taxes, they are in default under the reverse mortgage and they can foreclose. So you have to stay on top of everything else. You have to have equity in the home to qualify for the reverse mortgage. And you have to also maintain the home. It can't go into total disrepair, which is why you have to keep that homeowner's insurance as well. So a reverse mortgage balance grows over time. So in a regular mortgage, let's say you start out this one, well, the number's not on here, but like, let's just assume it's a $250,000 mortgage. The loan balance goes down over time. With a reverse mortgage, your balance goes up over time. And so the amount to pay off gets higher and higher and higher as it goes on. And most people who get a reverse mortgage aren't looking to buy back their home, but it's an issue for heirs. And we'll talk about that in a second. So like that last chart showed, the loan balance increases over time because of the mortgage insurance, the interest, and the fees, because interest and fees are going up every month. So sometimes the low balance might get so high that it's higher than the value of the home. The way reverse mortgages work basically is if someone doesn't pay off the loan when someone dies, it goes back to that mortgage company. And so if someone lives for a really, really, really long time, like longer than someone was expecting, the value of the loan might be higher than the value of the home. The loan might be higher than the home value. It might be assigned to HUD if that takes place. So the loan balance becomes due when the borrower sells the home. So if someone sells the home, they have to pay the reverse mortgage before they get any money from the home or before the sale can take place. When the borrower no longer occupies the home for more than 12 months without permission. So like, let's say it's someone who goes into assist, rehabilitation, they fall and they had to be in rehabilitation for 3 months. They're going to be there longer than 12 months. That can be a default. The last surviving borrower dies. And so we're talking about married people here. So if a couple, if one person dies, the second person has to die, the spouse. Or the borrower defaults in the terms of the mortgage. And like we said before, that's normally non-payment of property taxes, HOA fees, homeowners association fees, or homeowners insurance. If the spouse, the borrowing person or the borrowers die, the heirs are required to pay off the loan balance if they want to keep the home, or they have to refinance it to keep the home. They might have to go through probate or consolidate title in order to do so. And if heirs are wanting to keep a home, they might need to act really, really fast because normally a home the balance has to be paid off within 30 days. We'll get to that in just a second. So why would people get reverse mortgages? So I'm just going to say, in general, Lone Star, well, I don't know if I want to say, in general, reverse mortgages are not good for all people. A lot of people misunderstand them. So the reason why people get them is because you can get payments as a monthly installment or a lump sum or as a line of credit. There's no restriction on how you use it. You can go use it to travel the world if you want to. You can use it for home repairs. You can pay off other debts. You can pay off an existing mortgage. You can pay off tax liens. So those are some benefits. If you're over 65, though, you may not, you may be eligible for tax deferral. Not if you have an existing mortgage. If you have an existing mortgage, you have to pay the taxes. And so it's just something to be aware of. They can use those funds if there's an emergency or to supplement financial resources. It can be good if they don't have to pay that monthly principal and interest, like, unlike the traditional mortgage, they get to live in the home. But if they sell the home, they don't just get to sell it free and clear. They have to pay off the balance first. So they can still, use that equity during their lifetime. And so like, this is just compared to like the home equity loans or the HELOCs. Instead of paying it back over time, you don't have to pay it back because you're basically like saying, lender, you're getting my home when I die. And it works the best if you have no intention of leaving your home to your heirs, or if you know that your heirs or estate can pay off the loan. A lot of people don't realize that their son, or, like maybe they have a disabled child living with them, that if they get a reverse mortgage, that disabled child cannot stay there when they die. And that's a common misconception, and it causes problems for the heirs. And if you have the intention of leaving it for your heirs, a reverse mortgage generally is not a good idea if that's a priority for you. So the risks are not all properties or homeowners will qualify. The spouses, if you're not both age 62 or older, you may not qualify. The property has to be in decent condition already. It has to be insurable. If it doesn't already have insurance, it has to be insurable. And some properties simply aren't insurable because they haven't been maintained. Or maybe you have existing liens and they're not sure that they're ever going to make any money from it. So the other thing is that a lot of people really, really misunderstand the tax deferral, and that causes problems for people, and they can face foreclosures on the home they expected to live in until they died, and they quit paying the property taxes because they're otherwise eligible for it, but that's a term of default under a reverse mortgage. So you have to be prepared for that. And I believe that there are Amos presentations on property taxes as well. You can still be foreclosed on. So other additional risk are if you don't pay the property taxes, if you don't maintain and pay for your property insurance, if you don't pay your homeowners association fees. That's assuming you live in an HOA. If you live in an HOA, those fees still have to be paid. You have to maintain the home in good condition, and you can't leave the home for more than 12 months. You can't leave it to your heirs unless someone is going to pay it off. And like I said, normally it's a 30-day payoff period. So that's a really quick turnaround. And so like if the loan is worth $200,000, that means that someone's paying off $200,000 in 30 days. Non-borrowing spouses can be at risk of foreclosure on certain ones. You can't be absent from home for more than 12 months. So if you're planning on traveling the world, it can't be more than a year. You can get lender permission, such as a need to move into a healthcare setting. We'll talk a little bit more about that on another slide. Interest, loan insurance, and servicing fees are added to the loan balance each month. So even though the loan, the amount that the person might get might be $100,000, in order to pay it off, it might still be $200,000 or more. So the loan amount doesn't equal the payoff amount because there's always interest and fees. And the loan balance might exceed the value of the home. So like maybe the home is worth $100,000, but the payoff balance is $200,000. So that means that your heirs would have to pay more than what the home is worth in order to keep it. And that's not a good investment, for the heirs either. So there are some defaults. We went over some of the defaults, but we're going to talk about different loss mitigation for reverse mortgages. So the vast majority of reverse mortgages are FHA, Federal Home Administration, backed reverse mortgages. And they have special loss mitigation options. There are some non-FHA, some private reverse mortgages. So you have to know who yours is with, but the vast majority are FHA. And if it's not FHA, then you have to check with your investor, the owner, to know what the options are. So the ones that we're discussing are FHA reverse mortgages only. So if the borrower is not timely paying the property taxes or the property insurance, the mortgage servicer will pay it to avoid the tax foreclosure or uninsured property damage. They do this because they don't want to lose their investment for not paying property taxes, or if there was a casualty loss, a fire, a hurricane, a flood, things like that. They don't want to lose their investment because there was no insurance. They will pay for it. The borrower has to repay the lender if the lender pays it for the borrower. So not paying it and just hoping they won't notice is not a way to go. So in order to repay it, they'll review the borrower's income and expenses to see if they qualify for a repayment plan. If they do, then they'll have to repay the servicer in equal monthly payments for up to 60 months. They don't want to offer you a 60-month right off the balance, but they're supposed to be able to offer you up to 60 months, which is 5 years. People are working to try to extend the HUD limit to beyond 60 months, but just be aware that that's the cap as of right now. The repayment plans are generally only offered once, but there's new HUD guidance, or relatively new, that says that you can have 2 chances to do this for arrears that are over $5,000. Not everyone qualifies for a repayment plan, but there's new HUD guidance that says if there's a reasonable expectation of performance, then it's supposed to be offered. So if someone is on a fixed income and cannot work, like they're getting Social Security, and they cannot work or do anything to make it go higher, and the repayment and the monthly payment exceeds the amount, that person may not qualify. But maybe they can get a job, then maybe there's a reasonable expectation of performance, or maybe they have a job and they're expecting a raise. Those are reasonable expectations of performance. So the amount owed can now be $5,000. It used to be capped at $2,000. And people who live in Texas know that we have high property taxes, so that's a good thing. Just one note, with a reverse mortgage, you are still eligible for the homestead exemption, and assuming that you're over 65, the over 65 exemption. And if there's anything else like, veterans disability or other disabilities, make sure you always have those exemptions in place. The lender may agree to informally allow the borrower to cure the default if the borrower expresses a willingness to repay the charges. So that's not a formal agreement, but an informal agreement. And those are informal delays. For a reinstatement, borrowers have the right to reinstate even after there's an acceleration. So if the borrower can pay the charges that caused the default, they generally have the right to reinstate the loan. Attorney's fees and costs can be added to the loan balance, but they can't be included in the reinstatement quote. And you can only do this once every 2 years. So if there are attorney's fees, because they sent this to attorney collections, that will have to be paid off over the life of the loan if someone's going to keep the reverse mortgage, or it adds to that balance that the heirs have to pay off. But if they're just trying to reinstate, they don't have to pay the attorney's fees for that. A borrower can possibly defer foreclosure indefinitely if the youngest borrower is at least 80 years old and there are critical medical circumstances like a terminal illness or physical disability that would be made worse by foreclosure. So like you have nowhere to go and you need the home to live in. And the borrower must not qualify for a repayment plan or must default on a repayment plan. All 3 of those have to be met to defer indefinitely. A doctor has to explain the issue in a written letter and send it to the mortgage servicer. It's not just a self-certification or anything. It has to be done by a doctor to explain the terminal illness or the physical disability. The borrower has to submit the request for an extension to their servicer, and then the servicer submits the request to HUD. If it's approved, the foreclosure will be extended for 1 year. Rule changes that went into effect last year removed the recertification requirement. And I'm just going to be honest, I don't know if any of the rules have been changed since April 29th, 2024. There's also some protections for a non-borrowing spouse. And they're all referred to as MOE, M-O-E, for a mortgagee optional election. And those apply to reverse mortgages that originated before August 4th, 2014. That's because under the rules prior to that date, it was possible to issue a reverse mortgage without requiring both spouses to be on the loan. And when that happened, if the borrowing spouse died, the surviving spouse either had to pay off the entire low balance or would be foreclosed on. And the surviving spouse in this situation is called the non-borrowing spouse. It's optional for the loan servicer and contingent upon HUD approval. HUD takes over the loan instead of allowing it to be foreclosed. and the non-borrowing spouse remains in the home. In order to qualify, both spouses must have been married at the time the loan originated or have been in a relationship akin to marriage and married once legally allowed. So that could be like, for example, same-sex marriage wasn't allowed in Texas until 2015. But then it says, but then you have to actually get married, if it wasn't allowed prior to that date. Also, the non-borrowing spouse must not have remarried and must have a legal right to occupy the property. So if you've remarried, you give up that right, and a legal right to occupy the property, like you're not in prison or something. The non-borrowing spouse will not be able to draw on the loan. They don't get any, so if the borrowing spouse could have still made draws on the loan, the non-borrowing spouse can't. They still have to pay the taxes, the HOA fees, and the insurance. The lien remains on the home, even if they otherwise inherit it. So let's say the person had a will and they said, I leave it all to my spouse. They still only have the right to live there until they die. They don't just get it free and clear. So just be aware, if it's prior to August 4th, 2014, you have to communicate with the servicer. And after, both spouses are required to be on the loan. And so it should enter the deferral automatically. In both cases, insurance, taxes, and HOA fees have to be paid. So if the borrower for a reverse mortgage was not married or both spouses have died, then there are options for the non-spouse heirs, the children or grandchildren, nieces, nephews, brothers, sisters. Probably never a parent because of the age requirement. So up to the non-spouse heirs are allowed up to 2 90-day periods after death of the borrower to do one of the following: pay off the loan, refinance the loan. It may require consolidation of title. That means clearing up, that tangled title, clearing up title. They may use another reverse mortgage if the heir and the property still qualifies. So that means there still has to be equity in the home. If the value, if the person got 100,000 and the loan's now worth 100,000, that's not going to be a person who qualifies because there's no more equity. They transfer title to the lender via a deed in lieu of foreclosure. And that's where you say, instead of foreclosing it, I'm just giving it straight to you. If the loan balance is more than the home is worth, they can sell the home for at least 95% of the current appraised value, and that results in a short sale. The value will be based on independent appraisal, not the county appraisal district. So if you go to HCAT for Harris County, if you go to HCAT, you can see what HCAT appraises the value at. They're not talking about that. They're talking about an independent appraisal. The heirs can ask for an extension of more time beyond the 2 90-day periods, but there's no guarantee. They have to show that they're making progress towards the resolution, such as probate proceeding or sale listing. And they may now qualify for up to $7,500 cash for keys or up to $5,000 for probate costs if the heirs are doing deed in lieu, a short sale, or before the completed eviction. This is if they are engaging the lender. Because generally speaking, it's due 30 days. So that's only if you're engaging the lender. FHA has a flyer, and I know that this is too small for probably most people to read, but you have to get in there fast if you want to, if you're trying to get any remaining, let's say the home is worth $250,000 and $100,000 is owed on that loan, but they don't want to keep it. They can sell it and still get their $150,000, pay off the $100,000 owed to the lender. They still get the value. So that might be why you're wanting to go through it. You need to know what the options are. But you can go and to the FHA website to see what the options are. What if you don't qualify for loss mitigation? There might be some additional options. It really depends. It's very circumstance specific. Sometimes some people can refinance a mortgage with a new traditional mortgage, or potentially the reverse mortgage. Filing for a Chapter 13 bankruptcy, that's if you qualify. With a Chapter 13 bankruptcy, you're required to have enough income to pay your monthly expenses, including any mortgage, property taxes, homeowners insurance, HOA fees, and the balance that you owe for whatever the default is over the course of 3 to 5 years. If you don't have enough income to do that, you won't be approved for a Chapter 13 plan. And there's other issues with bankruptcies as well. But it is an option for people to save their homes when they're facing foreclosure if they have enough income. You can also sell the property before it's foreclosed on the open market. So if you have a $250,000 house, let's say you've been making payments on it for 20 years, you lost your job, and now the $250,000 house is worth $350,000, you owe $100,000, there's still $250,000 equity. Maybe you can't afford to pay it, but if you sell it, you can still have that equity go to you, and take that money and use it for something else. With your service's permission, sometimes you're allowed to sell the property for a lower amount than what's owed. That's called the short sale, or do a deed in lieu of foreclosure. That's where you just sign over the deed to the mortgage person instead of them foreclosing, but you don't get to keep the property that way. Sometimes they will offer limited relocation assistance, and depending on the value of the home, there could be tax implications. So you want to be, before you do either one of those options, you might want to talk to a CPA. And for all of these, if your home is foreclosed on and you are still living there, the new buyer has to file an eviction lawsuit to remove you from the home. I did say that eviction lawsuits are expedited lawsuits as well, but there is still a legal process that they are required to follow to remove you from the home. And Lone Star does help with evictions as well. There's not so I'm not going to go into it. Yes. So, resources, if you're having issues, are HUD approved counselors. Not everyone is a HUD approved housing counselor. They're not employees of HUD, but they are HUD approved. You can go to the HUD.gov to find HUD approved housing counselors. Now we're going to discuss some non-traditional mortgages. Contract for deed or executory contracts. These are found in Texas Property Code Chapter 5, Subchapter D. An executory contract, I'm going to go through these, is a long-term agreement to buy property. It is not a traditional owner financing. And the main difference is the seller retains title to the property and the buyer does not receive a deed to the property at the time of sale. At the very, very beginning of this presentation, I said that, a lot of people say that the bank owns their home, but I said, no, you own it. You have title. They just have another document that says they're allowed to foreclose on the home if you don't pay your loan back, but you have the title. In a contract for deed or an executory contract, the seller keeps the title and does not transfer it to the buyer at the time that the sale is initiated. The buyer normally makes down payments followed by monthly payments over time. In order to be an executory contract, it has to be more than 6 months. And with an executory contract or contract for deed, the seller is supposed to transfer the deed at the time of the final payment. So instead of doing it, the initiation of the sale process, they do it when the last payment is made. They're also called land sale contracts or installment land contracts. So sometimes people do these because they have low credit scores, they have a recent bankruptcy, or they can't get financing from a traditional lender. Maybe they don't have a solid work history. Maybe they have a really high debt to income ratio. Maybe their employment's changed a lot. Or they can't afford a large down payment that a typical mortgage requires, or closing costs, or they don't have collateral to buy a home. Those are sometimes people who use executory contracts. These kinds of contracts are potentially predatory. Texas has added strict consumer protection laws because historically they have been used in a predatory nature. The Texas legislature found that, quote, executory contracts for the sale of residential property have long been disfavored because they encumber title without transferring title, cannot be sold in the real estate market. So if I'm buying a home with a traditional mortgage, I can sell it. When I sell it, my loan gets paid off and I go about my way. With an executory contract, because I don't have title, I can't sell it. So they can't sell it in the real estate market, can't be used to borrow money. So all the money that you're making, all those, the equity you're building in your home, you can't take out a home equity loan if you wanted to. and are potentially abusive transactions under which legal title to homestead property may be withheld until many years after the buyer has built a home and made other expensive improvements. So when you're looking at what's required under Chapter 5, Subchapter D, it applies to any transaction involving an executory contract. That means you get title when you make the final payment, not at the beginning, to be used as the residence. It doesn't apply to commercial properties by the purchaser or the purchaser's family member, where the contract is to be completed more than 6 months, 180 days from execution. It can include a residential lease agreement with purchase options, but some of the consumer protections don't apply in those. The most significant ones don't apply in those situations. It doesn't cover contracts with government entities or between family members. And normally the land has to be 1 acre or less to meet the presumption that it's residential and that it qualifies for this, that it is a contract for deed. And it has statutory obligations by the seller and remedies and statutory damages for violations. So the risks are the buyer doesn't become the legal owner until all the payments are completed. There are now options because of our Texas legislator incorporated them into Chapter 5, Subchapter D of the Property Code for the buyer to get equitable title during the term of the contract. But the buyer has to know about this and exercise their rights. And most buyers don't know and don't exercise their rights. So this is where talking to an attorney is very helpful. The buyer has limited control over the property while under contract, especially if it's not recorded. Recorded means that you take it to the real property records of the county in which the property is located and record it in the real property records. The buyer can record the contract on their own if it's notarized. In order to record anything in the real property records, it has to be notarized. If it's not notarized, you can use a signed notarized affidavit of facts, add it to the contract, and record it with that county. Oftentimes Oftentimes the contract for deeds are not notarized, and so that's why you'd have to attach an affidavit. So you have something notarized to attach to the contract in order to be able to record it. So the risks are the buyer risk losing the property and all the money paid towards the property if they default, because the seller can cancel the contract and retake the property, keep all of the payments, and the benefit from the improvement the buyer made. So instead of building equity in the buyer, the seller retains all that equity. The seller, sometimes when people are doing contract for deeds, the seller doesn't have clear title, even though they're supposed to. And if the seller doesn't have clear title, then the title you get at the end isn't good title. Like someone else may have a superior right to that land that you just spent 10, 15, 20, 30 years paying for. These types of contracts, I've never seen anyone use title insurance on them. So also the seller might take out loans on the property with mortgages and liens, even though they aren't supposed to. They're not supposed to under Chapter 5, but they might do it. And if the contract isn't recorded in the real property records and people are giving loans on these, then that loan could be foreclosed on. You could lose your home. Also, historically, and even today, sometimes we see it, the sellers, instead of foreclosing on the property like they're supposed to, when someone defaults, they just try to evict the person. And so, which is much quicker than a foreclosure. And then, of course, they keep the equity that way as well. So the key buyer protections under a contract for deed are that the buyer has the right to convert the contract. So the seller is required to record the contract, but I've never seen them do it, and often they do not. The buyer has the absolute right to convert the contract to recorded legal title at any time and without penalty or charges. The seller has no choice if the buyer wants to record the contract, so long as the buyer continues to keep paying under the contract. It doesn't matter whether or not it's recorded. They also have the right to request a balance and a trustee. So the buyer can demand to know the amount owed under the contract, and if applicable, the name and address of the seller's desired foreclosure trustee, because this is a contract to buy property. They're supposed to foreclose on it. They're not supposed to evict or just try to force you out some other way. So when someone forecloses, a trustee is always named in those documents of who's foreclosing on if there's a default. If the seller fails to respond within 10 days, the buyer can determine the amount owed and, if applicable, select a trustee. The seller has 20 days to contest the amount determined and must send a written objection to the buyer. The seller's objection must be based on written records maintained and regularly updated by the seller. So you don't get to just say, I'm going to owe a lot less than I do. It's supposed to be based on how much you really owe. The buyer also has the right to offset amounts that it owes the seller against the amount for which the seller is liable as a result of its violations. They don't need to sue the seller in order to offset, but people should not be offsetting without the advice of an attorney or with the assistance of an attorney, because if you get it wrong, it's a default and the other party has the right to foreclose. The buyer also has a right to cancel the contract for any reason within 14 days, which is not long, of the date of the contract by giving written statutory notice. So you have to look at the statute if you're wanting to cancel it to see what the statutory notice required is. How do you record your contract for deed? If the seller doesn't do it, the buyer can do it themselves. It has to be notarized because otherwise the real property records won't accept it to record. It has to be original or a certified copy, or it has to be attached to an affidavit. An affidavit is always notarized. So you can say like, affidavit concerning facts. You can say like, attached is the, my contract for deed. It is for this property. I have been making regular payments on it. My payments are, blah, blah, blah. And then sign it in front of a notary and have a notary notarize it. And then you can file it at the county clerk's office or by mail. So the notary's affidavit has to have your name. It has to state that the attached affidavit is a true and correct copy and that you're recording it under Chapter 12 of the Texas Property Code, that it's an executory contract for the conveyance of real property. It needs to have the property address, the legal description. So a lot of people, to look at a legal description, you need to look at the real property records for the title. Like whoever has title, like go back and look at the title transfers. It will always have the legal description. The description in the appraisal district is not the legal description. It's a shortened version of it. It might say lot 5, block 12, Lakeview Estates or something like that. But the legal description is probably going to be an entire paragraph. And so it needs to have the legal description. It needs the names of who signed it, the buyer and the seller, and the date it was signed, and that the contract was not already recorded, but it's being recorded in accordance with Chapter 5 of the Texas Property Code. And if the property is your homestead, you need to state that it is your homestead. What happens if a buyer defaults with the contract for deed? The seller is required under Chapter 5 of the Texas Property Code. The seller is required to give written notice of the default by certified or registered mail with certain statutory language and 30 or 60 days to cure. If the buyer has paid less than 40% of the total purchase price or less than the equivalent of 48 payments, a 30-day cure period is required. If the contract is not recorded, then after the 30-day cure period has passed, the seller can rescind the contract and evict. If the buyer has paid 40% or more, or the equivalent of 48 payments, or has recorded the contract, regardless of the amount paid or how many equivalent payments, the 60-day cure period is required. If the buyer then doesn't cure, the seller can sell the buyer's interest in the property at a foreclosure sale, and following the foreclosure, the purchaser at foreclosure may file to evict the buyer. So that's why it's so important to record these contracts, is to protect from losing all equity. If it's sold at a foreclosure sale and it sells for more than the amount that's owed, then the buyer would get, the person who defaulted would get the excess proceeds. And sorry, I finished a little bit earlier. Does anyone have any questions? I'm not seeing any questions in the chat.
I don't see any either, and I wouldn't know if there's any on YouTube or Facebook, because usually Nia tells us that. So I guess if there's no more questions, I'm waiting for there you go. Are there any questions, Cecile, or do you know?
No, thank you all so much for another great presentation, and thank you for all the information. Again, if anybody has any questions, please feel free to reach out to our partner, Lone Star Legal Aid. They have their phone number there for any services or any questions that you may have. And Miss Everett and Samantha, thank you all so much.
Bye.
Bye.
I didn't realize you were multitasking.